Welcome to another in the series of EPRA Mythbuster interviews, and I'm joined today by Meijer, a founding partner at ICAMAP, to look at some of the challenges but also what's required to drive further growth in terms of the European listed sector. Thanks for joining us. Given your wealth of experience in European listed real estate, from your perspective, how do you believe the sector has developed since the early 2000s?
A big change. Much more professional. We have seen a big change in terms of those days. You had many lifestyle companies for CEOs. Today there's much more data, there's more transparency, there's better corporate governance, a huge improvement, and we really have to thank the companies and EPRA actually for their commitments in this area.
And Harm, what would you consider to be the main factors hindering further growth in Europe?
I think first of all that is the obvious one. Europe, you have many countries, many languages, many cultures, many laws, many taxes. The more we can harmonize this, the better it is for property. Clearly not good what is happening these days in Holland with the Dutch REIT, which might be terminated. But we should all be on top of that, and this process continues to move forward. This is a long-term process, so in the meantime I think companies can continue to improve, there's still room, and I would specifically highlight understanding of capital markets. Some companies understand capital markets, some only partly, some absolutely not. And this can be dangerous. It is very important that capital markets get trust from the companies, because if there is no trust, they don't give the capital. And there is this saying, if in doubt, throw it out. Actually, I am today working on a book which also covers this in a chapter.
And you mentioned there, Harm, that companies have a role to play. Can you explain, I guess, what you mean by that?
First of all, it is very important that companies are being optimized at all times. Okay, I'm talking here about, do they have the right assets? Are they creating value? Are costs being minimized? Is the balance sheet okay? And is the corporate governance optimal as well? Frankly, you don't want to run into a downturn and that capital markets start to question whether you will make it, whether you would have to raise equity. In the end, I would say it is about track record, okay? And too many companies these days are really focused on every stakeholder there is. But you also have to focus on the shareholder, because in the end it is about returns, and if returns are not being generated, they will not give you the capital. So it should be about optimization and the right mindset. Secondly, is this focus on NAV, the book value per share, basically. There is this intense focus on, which basically harms the growth of the sector, in my view. And it is really important to take into account that a lot of elements are not being captured. First of all, it is based on a valuation which is done back in time, not today, not in the future, doesn't say anything about that. B, it is subjective, done by an external party. And 3, it doesn't include many elements. You know, if you look at the quality of management, their track record, the corporate governance, strategy is not in there. The balance sheet, in terms of how much debt do they carry, the debt maturities and the shareholder structure. So all these elements are not in this measure. So in terms of to facilitate growth, I really think companies, when the market is hot and you can raise equity, you should do it. And secondly, you should really focus on those moments that if you can do a deal which are adding value per share while not worsening the risk profile of your company, that is absolutely key. And in this perspective, I would like to highlight in particular cash flow and optimization of the company.
And Harm, looking at the capital markets, it's interesting that the EU is considering enabling fundraising between 20% to 40% without the need for a prospectus. Are there additional measures that you believe would be, I guess, valuable to stimulate efficient capital markets for European listed real estate?
Yeah, let me first say that that will be a positive. If it is easier to raise equity, that is one hurdle taken out, which is great, although we have to be careful that the alignment works between the companies and the investors. Clearly, we have to come back to the previous point, what I said, harmonization in Europe. I would like to add is also the MiFID rules, what impact they have today, because there is frankly very limited research out there on listed property companies. If you want to have access to it, you have to pay. And for especially small companies, it is virtually not there. Thirdly, I think there are too many rules today. I mean, you look at some of the annual accounts these days. These are very big bookworks. And sometimes they get so big that I think we are losing a little bit what we really need to focus on. Okay? Fourthly, but this is just more a personal feeling I have. It would be great to have a study once done to the impact of short sellers on our property sector.
And what additional financial measures would you recommend for the sector, and why?
Well, I think we have a lot of financial measures today. So I would first focus on that these measures are being calculated in the same way amongst property companies. That is the first focus. Secondly, how frequently they are being calculated. Most of them calculate them only once a year or half a yearly. And that would be great if you can move it to quarterly. If I could add a metric, I would probably add CO2 per square meter over the lifetime of a building or a whole property portfolio, because that is what the future is these days.
Thanks very much, Harm. Really interesting to get your insights. Thanks very much for joining us.
Thank you much, Richard. Thank you much.